you may make $15 an hour or more, but then your monthly debts are simply too high for the threshold. Even though you're able to make the payments on time, you're never late and all the rest of that jazz, the bank still has their minimums and their maximums. In this video, we're going to talk about the 4 things that would get you denied for a home loan in 2024. Let's get right into it. Number 1 is going to be your credit score. Some people don't know exactly what score they need to go into homeownership or even where to find it, okay? There's ways to actually see the score that the bank uses before you actually get your credit ran from a lender. You can actually go to myfico.com, that's myfico.com, and then you'll see where they have their advanced plan. The advanced plan is $30. You don't have to keep it if you don't want to, because it is a monthly plan, but it will show you all of your category FICO scores. There's a lot of different categories that FICO has. It's actually about 9 different categories, and one of those categories is mortgages, okay? And that uses what they call the FICO 2. This is the only way to see this outside of actually going to a mortgage lender and them actually running your credit, and then you'll see what that mortgage score is. But you do it this way, it won't affect your credit in any way, shape, or form. It's a soft pull, not a hard pull, so it won't even show up on your credit. You'll be able to see what your 3 scores are in the mortgage category. And what mortgage companies do, they drop the lowest score, they drop the highest score, and then the one that's remaining is the middle score. Okay, so for example, let's say you have a 600, a 630, and a 670. Okay, so in this case, the low score would be 600, the middle score would be 630, and the high score would be 670. They drop the 670 because that's the highest, they drop the 600 because that's the lowest, and the score that's in the middle is called your middle score, the one that's left over. It doesn't matter which bureau it is, but in this case, it would be a 630. And so you just need a 580 credit score to go into homeownership. Anything less than a 580, it's not that lenders won't work with you, it's just it's a very small amount of lenders that will. There are some other ramifications as well too, if some lenders will even go that low. But if you want to dig around the garbage, you can, but you could just work on getting your credit score where it needs to be, which is 580 or more. The second thing that gets people denied for a mortgage loan is that their income is simply too low. It's not necessarily debt to income. We'll get to that in a second because that's actually number 3. But number 2 is the main focus is that the income is just simply too low. So if you're around $12 an hour, $14 an hour, you really need to be around about $15 an hour. Now, you can still buy a home if you make $12, $13, $14 an hour, but you're going to need a co-signer, or if you have another business on the side. So you can combine different types of incomes, but you can only count the income that you have filed taxes on for the past 2 years. So if you have a job, it could be a different job, but if you were working, as long as you were working in the last 2 years with less than a 6-month job gap, then you're going to be just fine if your income is mainly W-2. But if you want to add additional income, let's say from a side hustle, driving Uber or whatever, then the only way you can count that income is if you file taxes on that income for the past 2 years. And again, that's with any type of 1099. That's the only way you can add that income. Other than that, the minimum income, there technically isn't really a minimum income. It just really depends on what you're trying to buy. So if properties actually cost, let's say the cheapest property costs $300,000 where you live, $15 an hour won't get you there, but $15 an hour will get you a home if there are properties that cost about $150,000. So it just really depends on how much property you're trying to buy. But just so you know, usually if the cheapest property around you is $100,000 and is livable, okay, then you're gonna need at least about $15 an hour, and that's the amount of income you're gonna need. That leads me to number 3. That's going to be your debt to income. Now, you may make $15 an hour or more, but then your monthly debts are simply too high for the threshold. Even though you're able to make the payments on time, you're never late and all the rest of that jazz, the bank still has their minimums and their maximums. And most banks have a certain percentage of DTI. That just simply means how much of your monthly income is going to your monthly debts. And if they feel that, hey, you have a $700 car note, you have this personal loan here, you got these credit card payments here, and the income is not enough, then what they're going to say is, hey, listen, we need to pay something off, or we need to make more income, or we need to have a co-signer, okay? And a co-signer obviously is going to strengthen the profile because now we're adding their income on too. Now, when you're adding a co-signer, to your mortgage, they also have to meet the requirements as well too. Their DTI can't be that high. Their credit score must be where it needs to be. Their income needs to be there as well too. So it still needs to be a strong profile. Now, for most people, again, most people are going to meet the qualifications. You really have to have a substantial amount of debt with monthly payments and really have to have a certain like lower type of income in order for a bank to just say no. Okay, but there are some cases in which they need to go and make some changes. And again, you could pay something off, you could refinance something, you could restructure it and consolidate all of your credit card debt into a monthly payment loan. So there's a lot of different ways around this as well. Then that leads me to number 4 is student loans that are in default. Okay, you cannot go into getting approved for a mortgage if your student loans are in default. How do you get them out of default? You have to call the student loan people, get on some type of a payment plan, and once you arrange the payment plan, then you'll be able to go ahead and position yourself for homeownership. But that's usually what they want. Now, what I recommend is that you talk to a lender before you actually talk to the student loan people. The reason being is because you want to make sure that the way you set it up is exactly how the lending company needs it. Sometimes people will get on a payment plan, but it's not an IBR, which is an income-based repayment plan, which most lenders like to see. And that's where it's more of a controlled monthly payment. But again, have that conversation with a lender before you go ahead and call the student loan people to make sure that it's structured correctly, because it's not the end of the world if it's not structured correctly, but you may have to redo it, re-sign paperwork and all the rest of this stuff just to structure a better payment plan. Okay, so I hope you guys like this video. You're most definitely going to love the next one, and I'll see you there.